Hello, Warriors. We have a little give back happening here today. I don't think it's completely unexpected. Do you? Good morning, team.
Good morning, good early morning, Dale.
How are you?
I'm struggling this morning. My trading app is dead on my PC and I can't get it to refunction.
Oh,
So I missed
gosh.
all the action basically.
All right, well,
But that's life.
There's always another bus around the corner, buddy.
Exactly. I'll wait for it.
Yeah. So, here's what I'm asking myself this morning. I'm sure a lot of people are, is that this rally that we had in euro and, sell off in the dollar held at look at where it held. I mean, 110 area right here. So, it would just be normal after a move like this or a rally like this to give back some and
I think so.
and consolidate gains. Same in the metals. I'm thinking 1950 is going to be big in silver, and we all know what's going to be big in gold. We should not negate the 1680 level. And I guess the question is it a break to buy, or are we going to abort the whole thing and start all over again? I seem to think even, S&Ps as well, some give back. In fact, S&Ps, the chart that has this, the less of a give back compared to currencies and metals. So, yeah. What do you think?
And it's all based on those yields, really.
They got almost down to 350.
I said yesterday, right? Just around below 360, and that holds. We're a little bit of a channel. Top side is around 350 right now, so I reckon going into ADP and perhaps the labor report tonight, on Friday, we will hover around in this 360, 380 range. That's what I expect at least. And then the dollar just followed. We kept decent levels, parity in the euro, 115 in the cable, and there's a few things. Gold as well in the 22-29 zone, and ditto silver above 21. I had some resistance, so it all makes sense. It all makes sense about trading a few ranges, and then quiet down a bit, do the yo-yo, and watch those yields and what's going on there going into Friday.
When's the G7 or 10 or 100 meeting next week? Do you know?
I was looking for it and I failed to find it. So somebody should tell us what's going on and where.
I bet someone in the room knows. They'll probably
they must know.
Text it. Okay, and Canada, same thing. What surprised me is because Aussie held up the best during that parabolic move to the upside in the dollar. And then once we had this, you could call it a correction or a pullback in the dollar, Aussie had the worst pattern. I could see how euro could put in a higher low a lot easier than Aussie. Looks like new lows coming.
Well, you look at the commodity sphere today. It's a sea of red. You look at
it had the weakest rally though. Were you surprised? I was, because I was going off the fact that euro had taken out its COVID low, the dollar its COVID high, and when you got to the, unless I made too much about this aberration down here, that it was holding up the best. It wasn't even near these lows, but on this recovery, it was the weakest. That surprised me.
Central banks divergence, in my opinion. RBA only did 25, RB and Z. So Aussie Kiwi was coming down. Perhaps some uncertainty around China, hesitation from the RBA. There's a lot of portfolios are still trading central bank divergence, in my opinion. So That's
I
that's
mean, you
gonna have
just
a lot
see
to do with it.
the difference, right? Aussie hasn't gotten close, and Euro took out, its COVID low by a long shot. That was,
Yeah.
so anyway, maybe we'll see the central bank. Maybe the central banks will have to do something. I was thinking yesterday, wow, didn't even need central banks, but
We
if they're going to
haven't.
retest these ranges down here,
Mm.
that'll
We
be,
haven't heard from any of the Fed members that they were saying we are going to stop. What they did say is that they will go a bit more data dependent. So there was that was part of the move, I think, from 340 from 4% down to
yeah,
360 in the tens, and then the retest of 4% in the 2 years. So there is always this recalibrating,
yeah,
reshuffling of the books, I would call it, more than really repricing. And the market it just feels to me that the market is a bit illiquid, because if you look at silver, for instance, lost over 4%. It's quite a move. And then if you look at stuff like, well, the euro did 1%, cable did 1.5%. Those moves
yeah.
are quite violent. So I reckon there's perhaps a bit of a liquidity issue right here and now, and the big boys are just wondering what to do next.
Yeah, that's a great point about, well, volatility. We had big moves up too. Silver was up 8% one day, right?
Yeah,
So I
absolutely.
guess we shouldn't be surprised by down 4%. That
No, we
this is
should.
like the new normal for markets.
Well, I mean, we warned about it, and I warned about it end of August. I think September things are going to heat up, and that's exactly what we got, and we're still there. So, and ADP now out in a few minutes, and then it seems that some revisions have already been out on some platforms, which were a lot higher than the actual number before. I've seen some revisions up above 300K, where it was 132,000 coming out last month. So the ADP might surprise, but then again, I mean, it's not completely correlated to the NFP. So I'd suspect we are going to yo-yo until Friday or trade a few
Yeah.
ranges, but it can go really fast inside the ranges.
Okay. And, WTI had this huge move from the OPEC announcement. I don't know if this is something I'd want to be short. It's giving back nothing. So, just ranking things, crude giving back nothing, actually higher compared to currencies and metals and stock indices, which are, just different magnitudes. But again, it's all one market. Everything went up together. Everything's pausing
Absolutely.
together. Everything, here's silver. Everything went up together. Everything's pausing together. So,
Yeah.
I mean, you can say you're trading, different instruments, but we're all really trading the same thing, aren't we? I mean, everything's going up and down together. There's no differentiation between currencies and commodities and equities and bonds. I was looking at bonds. They actually did not recover as well as the 10-year. Well, here's TLT. So that, I asked myself, do I want to buy this? And the answer is no. Here it looked like it was worth a shot, but now it doesn't. Still a confirmed low. So bonds don't look good. The 10-year looks, better, right? I don't know if we're going to make a new high here, but it does look like the long end. So you know what happened? Remember, like we're going to have Joseph Yang at the Trader Summit. And the big talk back then when he got very popular was called the Great Steepening. All right. And then, I sent him a tweet or two because we went to an inversion again, right?
Yeah.
I said, what happened to the Great Steepening? And maybe it was just put on hold. And maybe now we get the Great Steepening where the closer end of the market, when yields are going up, don't go up as much as the long end.
Yeah.
And when yields come down, they come down faster
Mm.
than the long end. So, looks like the great steepening is trying to reawaken here.
Well, I mean, if you get a weak labor report, we might break sub 4 in the twos and then go back down to 380 or more like where the tens are, and it could re-steepen, but it's all like an if and when and if it happens, right? We had data starting to look a little bit more fragile, but again, is 1 month going to be enough to re-steepen the curve? I'm not.
Yeah.
I'm not sure. We'll just have to wait and see what happens.
I'm thinking I would be a seller up here at 390 or so if we got back up here and over the high. Go ahead.
Good morning. Good morning.
Good morning.
I want to say good morning because we have we have data in about 5 minutes. We have ADP data that's coming out. So we got to be kind of heads up with that. Especially we've seen the dollar, bounce back ahead of the
Grab
data.
the screen, bro. Will you please take?
I will. But I want to first of all, I want to say good morning to Kman. And been listening to you. And I know you're stepping in for Ryan. And the flow show.
Oh, big shoes to fill.
Okay. He's turning 50.
I said, don't worry, I'm a big boy.
But it's nice to have Kman here, and then I know Stelios, were you there today as well?
I was there, yes, of course I was.
Did you guys have nice peaceful conversations without Ryan today?
Yeah, without Ryan, who's so loud. No, it was good.
All right, well, that's good. You were talking a little bit about silver. I'm going to just kind of give you my outlook on silver, especially after having like a 8% run yesterday. Silver, just to give you guys some perspective, we rallied and stalled at the 38% retracement, also previous support. So
you brought that up yesterday, Blake. So this is not, rear view mirror stuff. I remember you saying.
Yeah, that's right. That's exactly right, Dale. We knew that 38% retracement, 2116 was going to offer some resistance. And so if you just think about silver stalling at 38% retracements, then we have to assume that this 38% retracement is also going to provide us some support that comes in at 1997, and that also coincides with the breakout point. So whenever I can get technicals lining up different ways and you get a confluence of technical levels that all land on the same spot, that's usually a good place to start looking for pivots, and that's a great example with the silver. That's why I wanted to bring that up. Now we have data, ADP data coming out here in just a second. That JOLTS data came in weaker. This is exactly what we want to see. We want to see the data weaken with ADP. We have ISM services data today. If data continues to show weakness, and then especially in the jobs report going into Friday, which I think I picked 150,000 jobs. Anyway, if we start seeing data weaken, that's a good thing for stocks, and we'll see stocks recover some more. So ADP, we're looking for 200,000 jobs. What do you guys think? What do you guys think?
Darts number.
What's that?
It's a wild darts number.
It is a wild darts number, right? There's not a lot of reliability with ADP, is there, Kman?
No, because it's, as I said, it seems the review data. I don't know whether it's a mistake or being leaked, but last time it came out 132K. Apparently, it shows on some screens that it's been revised to up to 300 or so.
Yeah. Well, let's see when it comes out here. We've got about 20 seconds. Let me pull up the data flash. This comes with ForexAnalytix. I'm going to go pull this back over here and push this down right here. So we're looking around 200,000 jobs. We have the euro dollar, which is exactly inverse anyway. And then S&P, I should probably put this in gold, but we'll just wait for the data to come out.
208.
208. Look at you. 208. So that actually came in a little bit better than expected. The euro's slumping. The dollar is going to push up a little bit. Stocks, again, they don't like when the data is good. We want to see that data weaken a little bit, and it didn't. So as a result, stocks are just kind of holding up here. ISM is going to be the more important data because it will have the employment component in the ISM, which I think is going to be key for us to find today. Key for us to see today. So what's up with the euro, guys? What happened in Europe? Data was released. A lot of European data came out. What was the primary driver of this euro pullback? What would you say?
Parity.
Parity?
Big trend line at parity, right at parity. I think yours is a bit too high, Blake. I think the same one around that I'm watching is right on parity.
You know, I've connected, if you can see, you know, my chart here, I've got 1, well, you can call that 2, 3, 4, you could call that one 5, multiple points of you know, I'm a loss for words at 5 o'clock in the morning. Dale, help me. Oh, it's still 5 o'clock in the morning.
Trend line touches. Trend line touches.
I'm at a bit of a loss there.
No, I see what happened. It's not connected.
I was taking the nap. Like,
okay, man, I'm looking at.
yeah. I see what you did, and it's okay. It's good yours as well, but I connected the April high 1, 2,
April
and then
high,
and that comes in a bit lower. It does cut some of the wicks of the.
You're just
that's
taking
illegal.
you're just taking out wicks here. I get what you're saying. You could do this, and you can actually just knock out these wicks, and it's basically there. Depends, you know, trend lines, there's no perfect way, and I like to explain to people that just because I draw a trend line one way doesn't mean anything. I adjust my trend lines throughout the course of the day, all the time, and that's one of the things about having, you know, multiple shows throughout the course of the day with myself and the rest of the team is we'll sit here and we'll look at like, you know, the Aussie, and we'll say, okay, well, we're seeing a bear flag pattern right now, and I have my trend lines drawn like this, and by the end of the day, you know, based on price action, we could end up doing something like this, and then readjusting those lines like this because you had some spike up that failed above highs, and then next thing you know, your you know, trend lines are changing a bit because of what price has done. So whatever I'm doing is not set in stone, and that's one thing that I always try to make sure that everybody's clear about, that technical analysis is not an exact science. It is a bit kind of like being an artist, isn't it, Dale?
All trend lines have a destiny to be broken.
That's a great point. It's a great point, and that's true.
That's their purpose on Earth.
So that's why, you know, when we're doing when we're doing and this is true actually, when we do analysis, you know, we take trend lines, we try to, you know, match them up with different fibs and, you know, relative strength if it's divergent, or, you know, your oscillators, and maybe even a Ichimoku cloud, you know, and you might look at that just to, you know, see where you're finding that confluence from time to time, and that helps you, you know, sharpen up whatever you're drawing. But anyway, that's a elongated answer about our trend lines that we're drawing. So you see that and Kman, I have to agree with you as far as the euro goes. Parity, I mean, parity is a big deal. I mean, how many orders are stacked around par, would you think?
Yeah, no, I think there's a lot going on still about around parity. I've said it already a few times, but it is a big deal psychologically, for sure. And I think there's a lot of structures being put in place around parity. It's whether it be corporate or specs or asset managers also, or contracts for different stuff. Is there's probably a lot going on around parity.
Yeah, I would assume there is as well. I'm sorry, Dale, I didn't mean to.
Well, when you think that, you know, people that were bearish and watched this euro rally, that they were just salivating at the chance to get short again at parity, And, you know, maybe they'll be right for a while, and that's what it takes is, you know, this is going to be really what we saw in the last week. It's really going to be the test. Can the bulls come back, the Euro bears come back and take control? And of course, they're going to try to parity, and they could be right for a while, but I think the game has changed. I think that's a bigger message.
Yeah, and you know, I was just looking at the S&P going, as you pointed out, rightfully so, Dale. I believe it's all one trade. Everything is, you know, dollar goes one way, gold goes the opposite direction at the same time. S&P will rally, Bitcoin goes up, you know, blah blah blah. It's all same risk on, risk off trade. It's just, you know, what asset class is your, you know, is your poison, really, is what it comes down to. So, you know, you look at the S&P, and I mean, how many people are like, okay, we just rallied. We had a nice, let's just figure out what a percentage wise, you know, we just had a nice 6.5% rally off the lows. This is where the stock market rolls over, and we go see new lows on the year ahead of the, you know, the Christmas rally, or the holiday. You know, everybody looks for a Christmas rally, you know, after you know, the Thanksgiving holiday, which is late November in the US. So we're gonna just pound the market for the next month and a half, look for new lows in the S&P from current levels after getting a 6% rally, and we should be, you know, selling off to new lows. How many people are probably doing that right now? And look, plenty, right? I would assume plenty. And I'm going to go back to what Stelios and I were talking about. Was it a week and a half ago, Stel? Where we said, hey,
I've forgotten what I ate yesterday, so I don't remember.
That's true. You know what? That is so true. You are definitely showing your age above 50. All right. So as we dip below 3,600 last week, we're like, okay, we can see a rally back to 3,900, you know, back up towards the 618 retracement. And we're on our way there. I mean, I personally feel we are going to see higher levels before we see lower levels moving forward. I know a lot of people are thinking this is it, and we're going to roll over to see new lows, but I actually think that the data this week is going to continue to weaken. I think we're going to continue to see ISM data not look so hot today, and you know, I think economic data is going to start to slowly roll over, and it's going to give the Fed some room to breathe. And step back from such a hawkish rhetoric. So that would be my opinion. What do you think, Stelios? Do you still believe that we can go higher from here?
I think we can. And to be honest, the path of least resistance now is still to go a little bit higher. But I think that the time for the Fed to start shifting is coming, and it's closer than, I've said this before, it's closer than people think. And I think this week's payrolls might be the beginning, but we're definitely seeing leading indicators fall. And you know, leading indicators take a few months usually to come through to the economy, and therefore for the lagging stuff to show. But I think the fall has already started. So I think it's a matter of time until we see it manifest itself and the Fed changing course. Will they do it now, you know, immediately? I don't think so, but I think it's coming. I really do.
All right. Well, I actually think that we are going to we're going to get we're going to get some weaker data, which is going to feed into some, you know, some recovery in equities. But that's how I feel right now. Kman, what are your thoughts here?
Well, I mean, what I've been saying, more or less like Stelios. I think we're seeing the premises of data starting to change, which is also logical, which is what really Powell has been saying as well. But it's going to take a move above perhaps 4% or towards that 4.5%. Yesterday, there was one of the Fed speakers who said that it's possible to see with what the Fed is doing right now and how they handle this, the situation to combat inflation, that it's possible to see unemployment tick up to 4.5%, but they are ready to go and see it up there. So but okay, I mean, if you're asking me, then if I'm selling dollars, not yet. That's
okay. So that was a quick answer to what I was actually looking for. So what do you guys make about the the difference we had between we had the RBA, which by the way, here's the Aussie, and Dale, just looking at what you were saying, or taking into account what you were saying about the Aussie, we have a bear flag pattern developing.
Yeah.
They actually raised rates less than expected. They underwhelmed the market, if you will. But you had the RBNZ that actually did a hawkish hike. The Kiwi spiked up to 58 cents, 58.05. If you are a ForexAnalytix subscriber, you knew that yesterday 58 cents was a really, really big key resistance. We hit that and dropped. I mean, we dropped over 100 pips since then. But you're seeing a big divergence between those two central banks, where the RBNZ is obviously still hawkish hiking, and then the RBA a lot less so. Do you make anything out of that, you guys? Any thoughts about that? Other than we need to continue to sell Aussie Kiwi?
Well, that's about the result of it, right? And that's what I said earlier. I mean, you got the divergence now between RBA and RBNZ.
Yeah. I actually think that this is a really good setup for shorts. I was short the Aussie Kiwi for the last couple weeks. Didn't make a ton on it because I was just kind of playing this channel. I didn't think we'd test the upper end of this channel, but we did. I still think that we play this on the short side until we get back to like 110. That's kind of how I'm playing it right now. All right, so we have just a few minutes before data comes out. I want to talk a little bit about something really quick. On Monday, I'm going to be meeting with a gentleman. Our first really big payout. We've done some payouts for a trader funding program. But our first really, really big payout we did just this week. I've chatted with the guy a few times because he's trading our capital now. So I'm going to do an interview with him on Monday. And talk to him about the trader funding program, and talk to him about how he's done it, and how he's managed to not only pass the assessment, which is not, it's the more trading part, and how he's done and continues to do really well in it. So I'm going to be doing that on Monday. It's going to be a pretty exciting interview. I think most of you guys and gals are going to like that. Just remember, the trader funding program is a program which has really, really been great for a lot of people. We've managed to do a lot of payouts already, which is awesome. Especially we've only been offering this for the last few months. So anyway, take advantage of that when you get a chance. Be ready for that interview, which you'll be able to hear next week. So for the rest of the day, what's your best idea right now, Dale? What do you think is like the best setup for you as far as a trade goes right now?
I'm waiting to buy weakness in metals and cable and euro. I feel could take into next week. Looking to going with what happened last week, I think, is the change, and not chasing things. Was fortunate to catch a euro at near the low, 95.5. I think, what was it, Thursday or Wednesday last week? So now I just wait and see what the nature of the pullback is. Could it be a zigzag, or does it really abort? But now I'm just sitting here waiting for the opportunity to buy breaks, and I don't do it on the first down day.
All right, well, that's a great setup, Dale. I like it. Stelios, what's your best idea out there? Long silver. Okay,
no,
let's move
ahead
along.
of the NFT, I don't have anything. Sorry, move on. Seriously, I don't have anything ahead of the NFT.
Come on, seriously, don't wussy out on me now. Give me a actionable idea. Like, I'm buying this, and I don't give a shit what Steve says. What? Come on, give me something.
Pass on to Steve.
Yeah.
Gosh, dang it, Steve.
Sorry.
What do you got?
I just want to listen to Steve for a week, and then I'll start trading again.
Okay. Interesting.
Steve, give us your best idea. What do you got here? What are you doing?
He's filling out
Data.
forms. He's not a
Data,
terrorist.
Blake.
You're waiting
Data.
for what do we got? The ISM data is all the data that I care about. So what do we got right now?
We had trade balance.
Ah,
It's the same as expected.
Yeah, it doesn't
Canadian data better than expected in building permits, but really
that you know, the dollar CAD has had a really nice bounce back. I mean, this is one of those that you got to be careful. I mean, suck people in short here, squeezed them out. Suck people in here short, squeezed them out. I mean, this is a little bit of a tricky one, especially that it's in a big breakout of this massive channel. So you got to be. I've actually left the dollar CAD alone for the last few weeks. I can't get my head around it, so it's all right though. All right, so what do you think, Kman? What's your best trade? I know we got Ben Maldonado coming in, so
I'm as I said yesterday in the room and the day before, I like the euro sterling 87 and below.
okay. Euro sterling, got it
No.
at 80. Wait. At 87, you want to buy it at 87 here.
I've done it.
You're already long, and you're going to continue to get long and
yesterday.
press higher. I like it. That's a great trade. I got stopped out. I think I probably got stopped out at the low.
we all did because we were too tight.
No, some people that don't trade with stops don't get stopped out, but anybody that's trying to manage their accounts and not blow up is gonna, you get stopped out certain times, right? So anyway, I'm sorry, Dale, what were you saying?
I forgot already.
Dang it. Okay, hey, look. Here's going to be like my best idea. I'm trading the US dollar Norwegian krona on the short side. And nice. Here is a nice little head and shoulder pattern. We're retesting the neckline, and with crude bouncing, and I think crude's going to rally back above 90. I know it's a lot of headlines right now, but I think crude's going to head higher, unfortunately. That's going to take us back down towards this 1037 and quite possibly even lower. So I think this is a great setup for a short, almost where we're at, because it's like a good risk reward to be on the short side over here. Anyway, that's my best idea. I want to thank everybody for being here today. Make sure you guys take advantage of ForexAnalytix. This is the last week. I'm telling you, this is the last week you're going to get prices below $100. We are going to 189. First time we're raising our prices in 4 years. We brought our prices down from $119 to $99. So you can lock in those prices and be grandfathered from here on out. And because that you're not going to see that again. So we're just letting you know. And you all know this. We don't mess around with the prices. When we say, oh, we only do discounts, a couple of times a year. Yeah, if you miss it, you have to wait for like 6 months. Well, in this case, our prices are going up and they're not coming back down. So because our costs have gone up substantially for all of our technology and our servers and yada, yada, yada. So take advantage of it while you can. All right, that's it for me. Bring in the Ben Maldonado. Love that guy.
X-rated, Blake. If you please remove your children. And if you're sensitive to, that everything has to be Pollyanna for you, you need to go too, because Ben told me what he's seeing, it's not so great. And I said, Ben, you tell it like you see it. So forewarned. Welcome back, Ben.
I'm going to go grab my tinfoil hat right now.
So you go hide under a rock,
cup of coffee.
Blake.
I'll be back.
All right, everyone go to their bunker and turn this on. Ben?
Hey, Dale, how are you?
Good, buddy. So, everyone's pre-warned. The kids are out of the room. Tell us what we have to look forward to on the epic cycle going into year end.
Yeah, it's not great, but always, out of the ashes rises the phoenix, and that's the hope, and that's what we have to see. All transitions are they're tumultuous.
Orange
and people, let me get the slide started. It's tumultuous and upsetting, but it's also creates incredible opportunities. And whatever new is going to start, it's not necessarily it's going to be bad, it's going to be different, and it may end up being better. So the optimist in me always tries to look for that sort of thing. So today what we're going to do is we're going to kind of, and I've done this informally, but formally we'll go through sort of how I work my process, which is I start from the cycles. Like, what are the big trends from the bigger cycles, smaller cycles? What are the trends? Then what are the fundamentals that support those trends, or that sort of are in the path of those trends? And then go to the technicals. And so we'll run through all that real quickly. I know we got a half an hour, so we're going to hustle. The first thing we start with is the overriding cycle, which is the big cycle, is the epic cycle. It's a 400-year cycle. This is the Great Reset, not what the bullshit that the WEF is talking about. This is the Great Reset. That's what's taking place. We're in the end of that cycle. If you keep this cycle in your mind when you're watching events, it makes it less traumatizing, less confusing. You sort of understand where we're going and what's happening. And what's happening is the loss of trust and faith in the institutions that organized and governed our societies all over the world is crumbling, right? And
I'd like to point out, I know you have a lot to go through, but I really am amazed that you pointed out that included the Fed. And what the Fed has done in the last couple of years, you know, missing the inflation issue, calling it transitory, and now probably overkill, giving the economy chemo where, you know, the cancer is gone, but the patient is dead, has me thinking about who needs these guys.
Right.
That really comes into my head. I mean, they constantly blow it. Who needs them? What are they there for?
Yeah, I agree. And this is the thing. If you can look at the events through this lens, instead of being panicked or confused or worried or all this, you start saying, okay, what are the opportunities, right? Where do the opportunities lie? If what Dale is saying is true, and I believe it's true, and I highlighted on the current screen, you see all the different organizations that have sort of fallen out of favor and have lost prestige and lost trust, and they continue to decay. The ones I highlighted this time are, I think, the most important right now. The Federal Reserve, as Dale said, the Federal Reserve has lost credibility with the markets. And a perfect example of what just recently happened, not just the Federal Reserve, the Bank of England, right? The markets laughed because they were doing QE at the same time they were raising interest rates. You know, in what bizarro world does that make sense?
Yeah.
And so this is how it happens. It happens gradually and then all at once, and just like everything in the market. So watch the Federal Reserve and the central banks around the world continue to lose credibility, because remember, a decade and for the last 13 to 10 years, a generation of investors have relied on the Fed to play the markets and get good returns. That's over. And if you don't realize that, you're going to get killed in the markets. That's over. What I'm really interested in is the next time they ease dramatically, what's going to be the market reaction? Is it going to be some sort of pop and drop because people don't believe them, they don't trust them, they don't think they have credibility? I don't know, but it's something to consider. The other one that I highlighted on here, the thing that happened in the UK is going to happen all over the world. Pension funds are going to be the problem. Retirement systems are going to be the problem. They cannot meet their obligations. They're in trouble. They're insolvent. And it's just a matter of time now before they blow up.
That's going to be a bailout, isn't it, Ben? I just can't see government not doing anything about millions of people losing their pension.
And you know what, Dale, I think you're right. What it's going to be is it's going to be the justification for this central bank digital currency and this UBI and all this. Yeah. Okay, you're not going to get your pension, but we're going to give you money every month. Yeah. And make sure you can, eat bugs.
Right.
I mean, you can sort of, again, when you look at it from the view of the epic cycle, that everything is deteriorating, you see how the pieces of the puzzle begin to fit together.
Yeah. What kind of bugs do you like, buddy?
Steak bugs. Thank you. So the epic cycle, right? If we lose faith in institutions, what are the ways we can play that? What are the instruments we can use that are going to be beneficiaries of that? Gold, silver, precious metals, hard assets are where people go when they lose faith in the paper. Right?
Technically, do you think last week was the beginning of it?
I do. If you look here on the gold monthly, this bar right here where you know we took out these lows and we took out support, you know, what was really good support. Almost if you go back and you look at your commodity charts long term, before they make a big move in a commodity, they'll take out all the lows, grab the stops in the other direction, and then they go. And I think we may have seen that move in gold. Now, I know people are worried about gold and the dollar and, you know, how are commodities going to go up? How's gold going to go up with the dollar? Go back and look at the 70s. Gold and the dollar went up at the same time. Gold and the grains went up at the same time. And the dollar and grains went up at the same time. The dollar and gold went up at the same time. So they're not mutually exclusive. You have to look back at a similar time to see what potentially could happen or what is more probabilistic to happening this time. So gold is one way to play the epic cycle. Silver, another way to play the epic cycle.
Boy, does that look good.
I mean, if you look at these charts and go back and look at your monthlies and you see, you know, they're pulling back to the breakout areas from multi-year bases in a lot of these commodities. So and we're going to talk a little bit about that. This fear of demand destruction is going to destroy them, just like in 2000 and just like in 2008 and 2011. I think it's a little misguided. Now, this next one's a little controversial, and let me explain it. I am not a crypto guy. I'm not a Bitcoin guy. I'm not a hodler. I'm not one of those people. But the asset class certainly fits the epic cycle very, very well.
You know, Ben, I finally came around to that. And I'm actually thinking, you know, especially with the CBDC coming out and you know, it sounds like you still think the dollar can go. And if there is any kind of, you know, the dollar trend reverses, I think that this is going to be an asset class that people are going to go to run away from the dollar. I think they're going to buy everything. I see guys selling shares of farmland online. It's an interesting site where you could, you know, and then I saw a guy on CNBC where they're standardizing diamonds in these little coins. They're actually in the coins in bars where they're going to be, and boy, does that remind me of the 70s, you know, I mean, everything, gem guys, they were all, people just wanted tangibles. They wanted tangibles. And I
think it's happening again.
Yeah, and Bitcoin, you look, you know, it's hard to carry, you know, 50 pounds worth of silver, 100 pounds worth of silver, but Bitcoin, gosh, you put a little thing in your pocket.
Yeah, just put it on a fob and walk.
Yeah, portability.
Yeah. So I don't think the clean out in that space is done. I mean, the excesses in cryptos were just off the charts.
Where's your box? 14?
No, it's about from about 8 to 11, 8,000 to 11,000.
Okay.
And I think that's where we're headed. I mean, listen, in the beginning of this year, there were 18,000 different crypto coins. 18,000. I think there's probably even more now because people keep trying to bring them out. So that whole froth has to get washed away. And when it does, I'm not saying buy Bitcoin, but because I don't know that they're going to be the leader, but you got to look for something in that space because it perfectly fits with losing faith in an institution we've relied on for decades. Exactly. So I think the cryptos is something you want to look at. You want to find the ones that are going to be the leaders. You know, you don't want the Yahoos or the pets.coms. You want the Amazons or the,
you want the blue chip.
You want the ones that are going to come out of it, just like in 2000. There's certain companies that came out of that internet debacle, and you know the rest is history. So that's the kind of opportunity that's probably coming there.
Okay.
The other cycle,
first time you've talked about it. me.
I was reluctant to because I'm not one of those guys, but it
Yeah,
fits.
I'm not
It
either.
fits the cycle.
Right.
It does. It
Got
does
you,
fit.
buddy. All right.
So this is the cycle, Dale's favorite cycle, brings back memories for childhood for him and me. The 70s to today were connected. We've gone over all these sort of things. I just show it because it's really important, because you guys were talking about it this morning with a great discussion about, hey, it's all one trade. It's all about getting inflation right. And if you don't recognize that this isn't 2008 or 2000 where there was no inflation, it's more like the 70s where we had really, really high inflation. You're going to get carted out of the market at some point if you don't get inflation right. So we have Nixon connection to Trump, Cold War connections there. Even Russia's coming back now, which is kind of interesting. The ones we're looking at now, because Jimmy Carter and Joe Biden are like twins separated at birth, it seems, we have a lot of similarities. The thing that I want to focus on here is the Fed being massively behind the curve. And the narrative that's starting to creep in that is going to allow risk to rally, and why we've seen this 6% rally in the last couple of days in the S&Ps, is they think, oh, they're not so far behind. They're going to ease up. They're going to take it easy. If the cycles sort of evolve as I think they're going to, they're not close to being done, because inflation's not close to being done. And we'll go over why. So how do we play this? How do we take advantage of this particular cycle? Last time I was on in August, I posted this analog of, and I called it the Roe versus Wade analog because that decision had just come out. I believe we're similarly traveling the way we did in 73, 74, more so than 2008, more so than 2000, which you see all over FinTwit, because of the difference in inflation. When we were talking, we were right about here last time. I think we're here now. Yeah. I think we're heading here.
Okay.
In the S&Ps. We'll see.
Okay. That looks deeper than 3,100. It's
in the 2000s.
Okay. And that's August. You're looking for that. This is based on your epic cycle, a low due in August 2023.
It's actually not the epic cycle. This is more the connection with the 70s. So it's the cycle connecting to the 70s. So it's a 73, 74 connection.
Analog. Okay. It's an
analog.
Yeah.
It's an analog, and they can stop at any time. The key thing about the 70s, and because if the analog doesn't work, it doesn't mean, oh, the cycle's not working. It's just playing out differently. The key thing is the background frequency of the 70s is the same as we're experiencing now. So the probabilities are we're going to have inflation. The probabilities are we're going to have weak risk markets. The probabilities are we're going to have higher interest rates. It's not guarantees, but you want to stack the odds in your favor, and that's what I believe you're doing when you take this into account. Okay. Now let's talk about the fourth quarter theme. On the lead-in slide, the sort of table of contents, it said winter is coming. Winter is coming, not just in the seasonal aspect, but economically. The reason why the inflation is going to be sticky and probably higher than most people think for longer is this background weather of economic limitations and shortages is going to continue, not just in the fourth quarter, but probably for 3 more years.
Wow.
And that is why it's going to be difficult for the Fed to ease without causing hyperinflation. It's going to be difficult for central banks to be accommodative without causing hyperinflation. So this is a key point. If we get inflation right, you're going to get bonds right, you're going to get equities right, you're going to get the dollar right, and you're going to get commodities right. So you got to get inflation right in this cycle. So am I looking for things where it's going to pulse, because that is part of the cycle, meaning it's not going to be straight up, every month higher inflation or steady. It's going to come down a little, it's going to go up, it's going to come down, but just like a growth stock, it's going to trend, and it's going to trend higher. So we have to watch that, and we have to be looking at the fact that probabilities favor. They're going to have to keep the monetary policy tighter and higher, interest rates higher than most believe, for a longer period of time. The next
I think
one,
communities should get together, and organizations, and build a silo and get long one futures contract of wheat, 5,000 bushels, and take delivery of it.
I think you're right. And
people would think that's lunacy, but especially if you could bring in people that would know how to store it and know how to refine it and turn it into product, that would be kind of a great Joseph strategy for people to have going into the end of the epic cycle. And it's not that much money. You think, okay, say wheat's $8, 5,000 bushels, what is that, 40 grand for delivery? So, that could keep you going through a season or so.
And Dale, what you're saying is exactly what the epic cycle is calling for, where less relying on the centralized, organized distribution system and saying small communities, small tribes, do it yourself. It's about the individual now. It's not about the collective. That's what's changing. That's going to be the major change on this epic cycle. No more collective. It's every man for himself, and little tribes and little communities and individuals have to take care of themselves. That's what's coming.
Because if Putin does become desperate and launches some tactical nukes, there goes the breadbasket of Ukraine for a generation or more. Those fields will be irradiated.
And that brings us to the next bullet, right? Expect a crisis in the fourth quarter. I don't know what it's going to be. Could it be Russia related, China, nuclear, food security, political crisis? Remember, we got an election coming up in less than 30 days or 30 days approximately. Could it be political? Possibly, but some crisis is coming. Revolution. We're already seeing it in places. Iran, they have a revolution on their hands right now. Sri Lanka, it happened. And again, it doesn't have to be a revolution solely about overthrowing governments like you're seeing in those countries. Could be a political revolution. Could be a revolution about how resources are distributed. Any of those things. The key thing is there's going to be a change of direction. And this ties in a little bit with the election. Change is one of the key things that's coming in this quarter. Big time changes. So the unknown of where those changes are going to take us is also going to be present. Markets don't like uncertainty. We are going to have massive uncertainty because we're going to be moving in directions and to places that we haven't experienced in a long, long time. So what do we do?
600 years.
What do we do?
Well, it's 400 years, right?
400 years. Yeah. So what do we do? Right? We're in an inflationary bear market. These are the strategies that you have to employ if you want to have success in an inflationary bear market. You hold higher levels of cash, you sell risk, you sell bonds, you buy real assets, because the goal is to have lots of cash so you can buy things at bargain prices at the market bottom. And that's sort of the rising from the ashes. That's the thing we're looking forward to, right? It's not the end of the world, but it's going to be the end of the world as we all know it. So there's going to be something new, and we want to have cash, not only to take care of our families, but we want to have cash to be able to buy assets at lows. That's the goal of this game. Here's an interesting cycle that I wanted to share with everyone. It's a 198-week cycle, approximately 4-year cycle that looks and identifies when financial stress hits the economy. 2023 is looking pretty brutal because it's right here. It's where the stress is going to peak out. End of 2023, early 2024. So again, it's just another indicator of a cycle that's pointing to next year is going to be a tough year if you are trying to buy risk or take risk or do things that are against the cycles that are sort of stacking up from a major cycle like you know, a 400-year cycle to a 50-year cycle to a 4-year cycle. It's not going to be a great year for financial
If you're
assets.
positioned in the right things, it could be a bonanza year for you.
It could be fantastic.
Yeah, so that's what I'm planning on.
Yep.
Bonanza. Dun, 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 dun.
Another 70s reference,
Yeah,
bonanza.
I didn't even mean it.
There you go.
Anyway, all right,
So-
go ahead, Bob.
Last time I was here was early August, and we posted this sort of path. We were looking for a high in August, bear market rally high. We got that. The next marker is a late December, early January low that will trigger another, what we believe is another bear market rally into February. And then that takes us down to the low in August of next year. So let's see how that looks on the charts, where we think we're heading. Right now, that's the latest best guess. 1900 ES in August.
Of
It
next
doesn't
year.
look good.
Yeah.
Okay. It would be about 60% off of the high at 4,800. So a pretty nasty bear market.
And the low, where are those lows coming in? How far back are those lows on the left side?
Here, this is like 97, 98. There's
Oh, okay.
2000. There's 2009.
Okay,
So
Got
these
it.
lows would be, you know, if we came into here, would put us in the range of the 2014, 2015 highs.
okay, because the 2000, 2008 highs, I think, were 1550.
Yeah, they were down. They're down here,
Yeah,
right
okay.
in here.
All right, so it's not the end of the world. We're just
Not the end of the world.
Giving back 40 years of gains. That's all.
Wait till we see the bond chart. You talk about 40 years. Here's the NQs. I mean, NQs, you're looking at potentially 5,200.
Yeah.
That's where a lot of the excess was. So it's probably gets
Right.
whacked a little more there.
Yeah.
Here's bonds. It's not often you get to mess around and play around with a 40-year or 50-year trend line. This is 40-year trend line.
Yeah.
We broke it.
Sovereign debt crises.
Yep, we broke it, tested it, and now we're sitting on really important support here.
Yeah.
If we lose that, it's par. Area of par is next on a 30-year.
Yeah.
So much higher interest rates. This would coincide with higher inflation and higher interest rates. So this is why, man, that inflation, getting inflation right is key.
Yeah.
Here's the dollar, the Dixie, sitting on really important support now. If we lose this area here, call it, you know, give it a little leeway. Generally, you can have an eighth move here in the square. If we lose that, you know, 107, 108 area, then you open up like 103 to 101. But again, even if it pulls back to here, Dale, we're just testing these highs. I mean, I think the dollar ultimately is, you know, headed up into the 120s.
Okay.
That's the dollar.
We almost got there.
Yeah.
Yeah.
So here's the thing I keep hearing from people is, oh, just like 2008, we're going to get demand destruction. And, you know, because prices are up, you know, commodities are going to, the supply of the commodity is going to explode and bring prices down. And what cures high prices in commodities? High prices. Well, what if we're moving into a stage of hoarding, just like you talked about, Dale?
Yeah.
What if people start hoarding commodities so that we don't have demand destruction? That means that this whole thing of, oh, commodities are going to collapse dies, right? That narrative dies. So you got to watch it. It again and the key thing is the cycles are calling for limitations and shortages. It's not the environment for bumper crops,
Right.
or
Weather,
gushers if you're talking about oil.
Yeah.
It's not the environment for that. What about the thing that actually is happening? It looks like to me is supply destruction.
Yes.
Look at the spending, CapEx spending of commodity producers.
Yeah.
2008, it went up with price. 2011 went up with price. It's going down with price.
Yeah.
And it's not just in the oil patch.
Mining.
Yep.
Everything. Yeah.
Here's some inventories for you. They're below 5-year median levels in almost every market. We already have shortages, and remember, if the cycle's right, the shortages are going to be around for 3 years. How do you play it? Copper.
Yeah.
Look at the pullback we had. Really sharp,
Nice.
strong pullback.
Yeah.
Right on top of the consolidation, the multi-year consolidation that we broke out from here.
Yeah.
Over here.
Yep.
We tested it. Looks ready
Held
to
it.
go again.
Yeah, like it.
And the other
Held
thing,
up very well during risk off in the last 2-week period.
the other thing I wanted to say about commodities, and I told this to Dale a couple years ago, given my outlook, I hooked up with a firm, and I'm working with a firm, became a partner in a firm that trades physical commodities. There is a major disconnect right now between the physical world and the paper world in commodities. And these inventory numbers that I'm showing you and these inventory things are a part of that. The paper world is saying, oh, it's 2008. The physical world is saying we have shortages. Demand exceeds supply in almost all the markets we trade in, which are copper and crude oil and the derivatives of the oil.
Try and find some U.S. Silver coin pre-65. You can't find them in a, you could get other coins, different countries. You could get silver, but try and get, your sovereign nation's silver. You
can't, or you're paying a 90% premium.
There, yeah. Well, not
here's grain
90%,
inventories.
But, 20.
Dale's idea doesn't sound so crazy anymore. Look at grain inventories.
Yeah.
Way below where they've been for the last 4 or 5 years.
Yeah, I think churches, every charitable institution should get long, December wheat of next year and take delivery.
Here's wheat. Does this look familiar to what copper and these other commodities done? Pulled right back to the breakout level, held support, and now we're moving up again.
Yeah.
How about corn?
Corn even better looking chart.
Better looking chart.
With that double top. Wow, that looks great. Yeah.
Right. So corn's bullish.
Beans. Okay.
Oil. No, and I'm not going to do beans. I'm trying to do less. Commodities here.
Yeah.
Oil is one of the keys to inflation, and it is ready to roll. Right. The supply issues in oil are off the charts bad because of the lack of investment in new wells, the lack of investment in CapEx by the oil companies because of their fear of being, if you look at their dilemma, they invest in oil, the government tries to put them out of business. They invest in oil and make money, the government takes their profit. Why would you invest in the business? You're just going to milk it for all you can, and that's what they're doing. The inventory levels in oil are really, really tough. My buddy in the business, in the physical oil business, Paul, told me last week, he said 80 is the new 60 in crude oil. Get ready for it.
Yeah.
And where are we? We're at 85. So are you buying near a high, or are you buying near what is probably very, very good support? Let's take a look. Here's crude.
Yeah.
Look at this pullback.
Yeah.
Right to the highs.
Right.
That we saw in, 2018.
Yeah.
I think crude looks good. I think crude is a higher number a couple years and a year from now. Natural gas, volatile as hell. But again, look where the pullback came from. We made, we stopped where we should have, which is this is resistance until you get above it. But look where we pulled back. Resistance up here, right?
You saw it last year, Ben.
Yep. And this pulled back right to here. Again, right on top of the breakout level.
Yeah.
I'm seeing it in almost all the commodities I watch. This is a little thing we do each week for people that want to hear what we're squawking about. And that's my Twitter handle for anybody that wants to get in touch or follow me. But it's the bottom line we're looking at is central banks are attacking demand. And the problem with commodities is on the supply side.
That's right.
And right now, it looks like those shortages and issues on the supply side are going to be with us for quite some time. So how are we going to see lower inflation, and how is the Fed going to reduce interest rates or become accommodative and all that without blowing out inflation? I don't know. I don't see how they can do it. So
Be a prepper, Ben Maldonado.
be ready. That's what I'm just saying. Be ready,
Yeah.
protect your families, put yourself in a position where we're going to come out of this on the other side, right? They're just like there's, a forest fire that destroys a forest, it regenerates. And that's what's going to happen again. If you have cash, you can not only take care of your family's immediate needs, but you can buy assets and you can be in a position to put things in at the lows and sit back for 20 years and let it compound.
I really wasn't looking forward to another Lazarus experience, but thanks, Ben. If you can rise from the dead, you could rise from the ashes. And, as traders, how many times does it feel like we look back on our career and it was almost a different life? And how many chapters we've gone through if we've been doing this for a while. So, Ben, thanks for, great work, because what you're presenting now, this is not new. You've been on this theme for many years, and we're getting another chance to reload here. So really appreciate you coming here and sharing the epic cycle, which is one that not many people besides you talk about, and educating the F.A.C.E community. And what did you tell me on our call about being prepared? What's that saying? Preparation.
I don't remember. What did I say?
I don't know. Forewarned.
Oh, forewarned is forearmed. Forewarned
There
is
you go.
forearmed.
Forewarned. You've been forewarned by Ben for years. So, get ready. Thank you, Ben.
No problem, Dale. Always appreciate your time and the work that you guys do there at F.A.C.E. It's really good.
Yeah.
Really good.
Yes, and Paul, we record these interviews, and Ben will tweet it about 50 times. So
Absolutely.
Catch it on Twitter. You're welcome, man. People are thanking you, Ben. And again, bro, appreciate it. Good hunting, and keep in touch. And we'll get back together in January, see how this year played out.
Sounds great.
All right, Ben.
Thanks,
And,
Dale.
you're welcome, buddy. My trading warrior brother, Ben Maldonado. Very good shoe. Yes, I think so. And you could join the team in 8 minutes. Okay, still time to get ready for the morning edge. And we'll see everyone tomorrow. Good hunting, and don't just count your pips, count your blessings. Adios.